On the Tape is presented by CME Group, where risk meets opportunity, and iConnections, reimagining how the investment industry connects. Welcome back to the On the Tape podcast. Guy Adami, and joining me now, you know who it is, the great Danny Moses. Demo, how are you?
You know who you are. You look marvelous. Let me tell you something. You look marvelous.
And I feel marvelous. Now, I want to ask you a question. I'm not looking to put you on the spot here. Hopefully you know the answer to this.
Oh, boy.
Do you recall what your wedding song was? Okay, that's a problem. That's a problem.
Yeah, I was thinking of my rehearsal song. Oh, it was a Carole King song. I can't remember.
Well, that's a problem. And hopefully your wife isn't listening to this podcast.
Oh, my goodness.
But you can think about it whilst I say a few things. I will tell
I'm thinking 1960s, 70s. I was married in the 90s. You caught me off guard. I'm going to get it in a second. All right. Anyway, please continue.
My wedding song was The Way You Look Tonight by Fields and Kern, I believe, made famous by the great Frank Sinatra. And I mentioned that.
Don't you ever change.
There you go. So, and during the course of our discussion together, you will, in fact, think of the song that you danced with your then bride and current bride at. So think about that. But I'm going to mention this. One of the great wedding songs, I think, of all time comes...
Oh, wait, I got it. Now and Forever.
Now and Forever. See that? That's beautiful. Now and Forever.
Please continue.
Which plays into this. But one of the great wedding songs is from the wonderful Etta James, recorded in 1960. The name of the song is At Last. At last, my love has come home. And on Sunday night, Danny Moses, as I was sitting down watching the football game, somebody called me and said, do you see what's going on in the gold market? Which I had not, because I wasn't paying attention. But on Sunday night of this past week, gold at its zenith was up some $62. And I mention At Last because you and I both have talked, along with Dan Nathan, that the gold market was finally going to start to show itself. And you know what? It happened on Sunday night. So at last, I thought we saw the breakout to the upside in the gold market. Now, obviously, that reversed pretty dramatically. At one point up $62, reversed almost $100. So we wound up down, some $45 or $50. But I'm here to tell you, and I want to start our conversation with this. The gold market, which we thought was in play for the longest time, is now absolutely in play, given what we saw Sunday, and I think given what we're going to see over the next few weeks. Thoughts on that?
Yeah, it was definitely a wake-up call. I think people scrambled. Now, I called you that night because you used to trade the thing, and so I wanted to get your opinion on it. And obviously, there were stops that went off and all kinds of stuff that probably happened. The news was that there was a bombing of an aircraft carrier drone tried to attack the U.S. carrier in the Red Sea. There was some stuff going on there. There was an attack supposedly in Peru on a gold mine. There was some macro things, which is part of the theme, obviously, for gold that were kind of going on at the time. And I think, if anything, it just woke people up. And maybe they probably bought it poorly. They finally got on the train at 21.25 or something. But I think it is a wake-up call. And I think, obviously, that was a new high, a multi-year high, or an all-time high, I should say, I believe, Guy. And I think now we've settled back in. But I think we will test it again soon because there's nothing going on right now. Again, I've been saying is you can call us bears on the market, but I basically turned a bear into the market into a bullish on gold, meaning if you're bullish on the market because the Fed's going to be cutting rates, then by damn, you better be long gold because if we're going to be pulling that off. So
yeah, I agree with you. And now I want to give me a second here because I want to sort of set this up. And I think we both believe, correctly or incorrectly, that so much of the global markets are predicated or built upon or contingent upon central banks, what central banks doing, specifically our Federal Reserve. And I think there's this thought out there, correctly or incorrectly, that somehow these central banks are all knowing and they got everything under control. So I think those sentiments are out there, and let's just put that out as a sort of a given for now. But in fact, if that's true, that they're the all-knowing and they got everything under control, then my question to you is, given that backdrop, why in 2022, last year, did central banks buy approximately $71 billion worth of gold, about 1,130 or so tons, and now this year, which is going to end in a couple weeks, are on par to do not only the same, but actually a little bit more. So if central banks are, what do they see, in other words? So if you're given the fact that they're seemingly doing everything right, they are buying gold for a reason, Danny. And one of the things that I've said for a while, central banks are hedging what I believe is their own ineptitude. So if you're of the belief that central banks got it, well, they're buying gold. So if you think they got it, they're buying gold. So by those definitions, you absolutely then have to be bullish of gold, I would think.
Yeah, and I think if you equate it to Bitcoin, if I could for a minute, just in the sense of it appears that Bitcoin's in very strong hands. We said that $15,000 ago on Bitcoin, and that's the case. I think gold's the same. I don't think we're going to have a move in gold from 2,000 to 3,000, which would be, the same type of move. But what I'm saying is, the point you just made, those central banks aren't selling anytime soon. So they're hoarding and buying. So now if you get any type of institutional demand, we've seen what a hint of the ETF market can do to crypto, right? Imagine in retail if it makes its way in. So I think it's got a long way to play out. And listen, you can be long this and long the stock market. I think both could work here. If your belief is that Fed cutting rates is going to make the markets go higher, that's a whole different discussion. But I'm not in that camp. But you can own both as somewhat of a hedge.
Now, the next part I want to talk about, because it sort of dovetails around the gold conversation, both you and I, Danny, have been concerned about what's going on in Japan. I've highlighted it. You've highlighted it. We've done it together independently. We were concerned about the weakness in the yen. So the dollar against the yen, I want to say topped out around 152.5 or so. So that speaks to a weakness in the yen, which we thought was alarming at the least. As we sit here today, some things have happened where dollar yen's all the way back down to a 143 or so handle, which doesn't sound like a big move, but I'm here to tell you, in the currency world, that's a big move in a short period of time. So people will say, well, that's good news, isn't it? And, listen, maybe it is. I mean, maybe some of the concerns around Japan have been assuaged by this move, but there's still a lot of uncertainty over there, Danny Moses.
Yeah. So, Guy, the next Bank of Japan meeting is, December 18th and 19th. And so with that, the Prime Minister of Japan met with the BOJ Governor Ueda yesterday. And I guess Ueda laid the foundation for the ending of the NIRP policy, the negative interest rate policy, which has been in place for a very, very long time. The market, again, caught off guard by this. So to your point, the yen traded in a range. It strengthened straight down to just above 141 at one point. We're settling in around the 143 level. That's basically a straight line from kind of 147, 148, right? So that market caught off guard. What did their yields do? Their 10-year yields went from 0.65 to 0.75. And then obviously these are big percentages moves in terms of where they came from. But to put in perspective, their 2-year yields are 4 bips. It went to 9, and their 5-year yields of 5 bips went to 12. Why is this important? It's important because the relative yield levels of Japan and the US, granted, they're still pretty wide, but if they shrink over time, it could make the Bank of Japan and investors in Japan sell U.S. treasuries. For the first time in a while, I think last month we saw a drawdown, I want to say of $30 or $40 million. It's still the largest foreign holder. It's over 1.1 trillion. But the point is that these are the type of moves that you have to pay attention to. To be fair, on the flip side, we were saying that the Bank of Japan should do something to defend their currency, because we've been talking about this for months of why people should care. But Guy, I think it's indicative of something else. And this is really important. And this has been going on now for years. Just the volatility in all these instruments that we talk about. We just talked about gold. I mean, for gold to go up and down basically in a $100 range in a period of several hours is insane. For the yen to trade in that range is insane. We've seen what the U.S. Treasuries do. We talked about the LME and nickel a while back and all these things that are occurring. The banks are no longer the strong hands that can hold this as intermediaries, is my point. And so I just want people to realize that these type of things that can occur, they seem to stabilize over a period of time. But imagine 2, 3, or 4 of these things occurring at the same time. And every time we have one of these moves, yes, there's someone that makes money. There's someone that's getting carried out. And so to me, it's just a matter of time. And I'm not that's not a thesis on the market in general. It's just something to be aware of. The volatility in every single asset class that it's out there. And then you see a move and then you try to solve for why is it there? And sometimes it makes no sense at all. This one obviously makes sense. So we'll see what happens at this next meeting. And then they have a follow meeting in January where they actually may end NIRP. So
I'm fascinated by it. I think it's absolutely worth watching. And again, I don't think it's over by any stretch, but you touched on something in terms of volatility. Now, the bulls in the U.S. equity market would say the volatility in those other asset classes lend itself to the reason why you should be bullish of equities here, because it's a safe haven. It's a flight to quality in the form of the U.S. equity market. And quite frankly, if that's been your thesis, to a certain extent, it's been playing out. My pushback would be, Danny, and I'm curious as to your thoughts, the volatility we're seeing in the bond market, as you mentioned, in the currency market, in some of these underlying commodities, the move in crude oil, for example. I mean, we start to talk about standard deviation moves that are clearly not reflected in the equity market with a volatility index either side of 13 or so. So I've thought most of the time incorrectly, a few times correctly, that it was just a matter of time before that volatility found its way to the equity market. But right now, it certainly appears, again, with the VIX at 13 or thereabouts, that the equity market is looking past all of this.
Yeah, and I think if your input you're looking at to buy or sell equities are U.S. Treasuries and what they're telling you, right? You just painted a picture that, 10-year yields dropped from 450 to 420. Let's plow in because why? Because the economy's slowing, because the Fed's done raising and the Fed may cut. Again, my theme at the beginning of the year is going to be when the Fed first cuts or when they cut more. Why are you cutting more? What are you doing? Why aren't you? So you're going to hit this level. There's an immediate gratification element to this market today of give me a reason to buy it, right? And if you're using these inputs, which is why these things are so important, as I mentioned before, price of oil. We can talk, Brenda, we're going to talk about that too. What does that mean? That's a positive for the consumer, positive for airlines. What if it jacks back up $7? Do you sell them all? My point is that you need to have a thesis stronger or understanding that you're going to have this type of volatility in all of these inputs. I mean, we are now from a rate cut chance in January for the Fed is 16%. I mean, it was 0 a month ago. We're 62% in a chance in March. It was 22% a month ago. That's what's driving this market. So I'm a big believer that the VIX, to some degree, is the cart and not the horse on what leads everything. And so we use it as a measurement, and I use it more just to tell me how complacent things are over a period of time. Inevitably, we see these spikes every 3 or 4 months, sometimes every 3, from 13 up to 19, and then it settles back in. So it'll happen again. I don't know what will cause it to happen, but it will happen again for sure, guys.
So it's a great segue to what I want to talk about. And first, I want to sort of apologize to our listeners and our viewers. I've been a person that I would say for the better part of 2022 and the entirety of this year, I've been very positive around the energy space. And at times I looked very bright. I don't look particularly bright now. As I sit here, ExxonMobil is trading around $98 or so. As a matter of fact, I think we're basically making a new 52-week low. The OIH is cascaded lower below 300. I mean, it goes on and on. And by the way, this is in the month or so after, these announced deals. The Exxon deal doesn't look like it's going to happen, but we heard Chevron, Oxy, all these different names seemingly into space with M&A. Clearly, it's to a certain extent, unbeknownst to me at the time, that marked the top. But the move in the underlying commodity has been fascinating in a word. And it comes right after OPEC, again, seemingly got their act together, OPEC plus, and they were going to make cuts. Again, should have been supportive of the price. It was for about 24 hours or so, and we're right back down. Now, I want to say something, and I'm curious as your thoughts about this. We had Paul Sankey on Fast Money a few weeks ago, and he too, along with, I believe, Halima Croft still, very constructive around the commodity and the equities, the underlying equities. But one of the things that he said that sort of haunts me is, if OPEC doesn't get their act collectively together and whatever they do doesn't work, what you could see, Danny, is the Saudis flood the world with oil, something they have done before, which is obviously not particularly constructive. So they could basically say, you know what, F you, this is what we're going to do. We're going to flood the market and let the chips fall where they may. So I will say this. I want to be clear. I'm still positive on energy. But man, oh man, what we've seen over the last couple of weeks, it definitely tests your mettle.
Yeah, listen, I mean, you have MBS in Saudi Arabia literally hugging Putin as he comes in with a handshake and a smile. So this is what we're dealing with in this world. That says a lot about what's going on in the world in general. Listen, there's two ways to look at it. People look at it as a sector allocation. So I'm going to come out of energy, go into tech or whatever I'm going to do, right? If you're still bullish on the economy overall, then you have to be buying oil here, because if oil is actually down because of economic slowdown, then you better wake up and understand that that is a precursor to something. There are a lot of indications of this. It's not just oil. You said I'm a buyer of ExxonMobil here. It's not so much trading it as it's just buying and owning it. Now your dividends on these stocks are going to be north of 5%. Let's keep in mind how strong their balance sheets are. These deals, I believe, were stock deals also, guys. So it affects obviously the entire complex. That being said, this is not the first time these energy companies have been through cycles. And let's keep in mind also that oil traded below 70, took out a couple of funds out in the UK not too long ago, proceeded to trade back up to the 90s. I still think we're in a range. And if you were to tell me now we're going into the low 60s or high 50s from here, you know what that means? It means we have world peace, which we're not going to have. And it means we have a massive economic slowdown, which is not priced into the market. And we have other issues to think about. So own the quality energy companies. Don't be selling them here, the ones that own, and don't let oil be the be all end all. These companies are prepared to handle. And the other thing, obviously, gasoline demand or gasoline supply is at a multi-year high, I believe, right? And that's one of the reasons I think we're seeing this kind of sell-off, this confirmation negative bias, I think, in energy is feeding on itself. I'm a buyer on dips of energy stocks here.
So as we sit here on a Thursday afternoon, to be clear, we're awaiting a jobs report as you're listening to this sometime this morning, today, Friday, we're Friday when you're listening to this podcast. So I'm of the belief, Danny, and I'm not suggesting I'm right, but I think obviously the Federal Reserve, although they won't say it, they want the unemployment rate somewhere between 4.5% and 5%. And just the way they wanted inflation higher, I said be careful what you wish for then. I'll say be careful what you wish for now, because what I think is going to happen is a non-linear move higher in the unemployment rate, where it starts to stair step up to somewhere between 4, 6, and 5%. To your point about a slowing economy, when you have a U.S. economy that is predicated on two things: people having jobs and spending money, and their access to credit. Well, bank credit is contracting and the unemployment rate is going up. So those two things together don't paint a particularly rosy picture. So obviously, sitting here now, I don't know what that number is going to be, but my sense is we're going to see a continuation of this theme as the unemployment rate starts to tick higher. Thoughts on the implications there?
It feels like the market's set up to like the number no matter what it is. If it's stronger than the ADP indicated it was going to be, great. We're still on strong footing, but hey, we still might get a rate cut. If it's weaker, great. Pull forward the rate cuts, but we're still fine. Everything else is indicating it's fine. But listen, unemployment has one direction to go. You could get a tweak down 1 month from 3.9 to 3.8 because the strike ended somewhere or whatever. But the trajectory, and if you listen to the Goldman Sachs conference, a lot of companies, they don't care what the Fed says. They're doing their own. These credit companies are saying 4.2, 4.4. 4.6. They're projecting what they need to project for their reserves. I care more about that than what the Fed does. But as far as trying to, quote, trade this number, it won't matter because this won't be out till tomorrow morning anyway. I think you could paint any picture you want. I like to listen to what the Walmart CEO said in an interview the other day. I think it was on CNBC, about Black Friday, about the pull forward in demand, about how there's still weakness out there. Nothing cataclysmic, but it's still weak. So I think that's why oil's down. I think that's why rates are down. I don't think it's any other reason. And so again, don't try to trade the numbers, but the bigger picture, guy, I think to your point, is things are definitely slowing and unemployment has one way to go. And we'll get into something.
I think it's higher. And you spoke about the Goldman Sachs. They had a financial conference that coincided with a bunch of these bank CEOs up on Capitol Hill, which I found to be somewhat interesting in terms of some of the commentary. But what did you glean from either one of those or both of those?
Well, I think the Goldman conference was kind of a non-event. You really didn't learn anything new other than what I just said. Companies are setting up their own credit reserves based upon what they're seeing, not what the Fed is seeing, which is good. And the banks, for the most part, are fine. There's some stuff here and there that are probably actionable, but I didn't look at it close enough. The bigger thing is the bank CEOs were at the annual Senate Banking Committee hearing, Liz Warren and everybody else that was there. And it's really about the banks pleading to not implement these Basel III regulations, which would literally require a tremendous amount of capital to be set aside. And the argument is that that's too much capital set aside. It actually will hurt mortgage rates because we'll be tighter. We'll have to charge higher. It will hurt our ability to lend. I'm sure there's some truth to that. It was funny, though. They asked Diamond about the FDIC. He says he wants to take over the FDIC because that's how bad they are. And then David Solomon made a comment. Someone asked me, goes, there's too much government debt. I'm concerned with your own house not being in order, that it's going to cause issues. That's what you should be focusing on. And what they all agreed on was that crypto should be regulated as securities. So all the banks you could see, everyone kind of agreed in the room on that for the most part. So it was a scheduled event. posturing all over the place. And I think Basel III will end up getting pushed out, maybe not changed as much as pushed out over time as we get into the first half of next year. And they realize that the U.S. government has allowed this non-bank financial system to grow, that they can't keep track of all of the things that are out there, right? It's much harder. It's easier. You may not love it when it's gathered in the big banks and you can see where the risks lay, but they've been spreading this out, which you could argue is healthier for, quote, the system, but is harder to track in terms of where do things stand. So somewhat of a non-event, but somewhat always entertaining. One other comment, Guy, which kind of brings in this private credit, is that Ken Moelis mentioned private credit. He thinks it's a good thing because he thinks it spreads the risk and it makes credit available, et cetera. I won't comment on that. But his other comment was on M&A and how he believes it's going to start to pick up in 2024. And lo and behold, while he's sitting there, we get another deal announced, obviously, AbbVie again going into the market. And he's saying that basically you've seen nothing yet. And that was part of the thesis. When you start to think about these large banks, look what these comps are going to be. If that window does actually open for some of these big Wall Street banks on M&A, the Morgan Stanley, the Goldman, JP Morgans of the world, those are pretty easy comps to compare when you think about how absent investment banking in general, for the most part, has been. But on this particular trade, Guy, on this merger that actually happened, or the proposed merger with AbbVie, AbbVie makes a bid for a company called Cerevel for $45 a share in cash. It's an $8.7 billion deal, symbol CERE. Interesting on this one is the stock went from $26 on Monday to $37 yesterday prior to this announcement of $45. That stock in the call option market normally trades about 320 contracts, a day on average. It traded 51,000 over the last 3 sessions. So someone at Trade Alert Data says, quote, this is 100% suspicious. So I'm sure the SEC do a great job investigating that, but M&A is on the horizon.
One of the topics that are near and dear to our hearts, Tesla, labor problems. I mean, there are a lot of things around sort of the Elon Musk universe over the last couple of weeks, not least of which a potential selling of shares in one of his larger companies. Thoughts on that?
There's a lot going on with him. So let's talk about Tesla before we talk about SpaceX. So the mechanics union in Sweden is upset because Tesla doesn't recognize unions there. And in conjunction with that, Norway and Denmark have both agreed to not export any Teslas to Sweden. And so again, back to the Starbucks kind of call that we had a couple of weeks ago, which by the way is down 10% since Red Cup Day. These union things tend to just build and build. And Musk has faced them before and they tend to go away. Doesn't feel like this is going away. Your third and fourth largest markets, I believe, for Tesla in Europe behind UK and Germany are Norway and Sweden. And so if there's any solidarity there at all, however, switching to SpaceX, which he kind of uses to keep people hostage to do everything else that he wants to do by threatening to cut off their Starlink access if you don't adhere to various other things, of which I'm sure that Denmark, Norway, and Sweden use Starlink. There's rumors in the marketplace. They're calling it a tender. I mean, they're selling shares. So insiders selling potentially at a valuation of $175 billion in SpaceX. The rumored amount is between $500 million and $750 million, I believe, that's going to be sold out there. So this is not raising new capital. This is insider selling, which I assume would include Musk. So keep an eye on that. But the Musk show goes on.
Stocks and companies near and dear to your heart, which, by the way, was having a miserable summer into the fall. The stock, I think, traded north of $27-ish, only to trade as low recently, I want to say as like 11 and change. GameStop, which has had a huge move to the upside. And again, business, whatever, indictment, no comment, but the move from seemingly a $12 to $16 is happening overnight. In percentage terms, that's a pretty big move, and you're still talking about, at least market cap-wise, $5 billion company.
Yeah, so GameStop reported they missed the revenue. The business continues to shrink. In the middle of all of this, the only investments they've been making outside of buying their own shares, which I'll get to in a second, that they haven't done in a couple of years, is to buy U.S. Treasuries with kind of the cash available. Cash has been dwindling. It's just under $1.2 billion now. So now they're giving Ryan Cohen the ability to do anything he wants with that money in the equity market, privates, publics, and I'm sure it's obviously long only. But here's the thing. GameStop has $100 million left, a little bit more, on their own buyback. It is his largest holding, right? It's everything he has. He bought 36 million shares a couple of years ago. He's added about 844,000 shares since. He is the largest holder of the company at over 12%. If you're a GameStop shareholder, you got to ask yourself the question, What better investment is there other than GameStop, which you're running? Why are you going to go mess around? And listen, he's still under investigation from the SEC in terms of what he did with Bed Bath & Beyond. So if you're the SEC and you see this change in investment policy, you got to ask yourself the question, can this even be allowed? But I'm pretty much out of the stock guy. I actually traded that one fairly well. I'm not going to deal with this nonsense. But people, come on. I mean, if you're really still in this thing and you believe this guy's a portfolio manager, have at it, because that's what he's going to try to do to make money in the company instead of trying to fix this thing. So good luck to everybody out there in the GameStop, but it really was mind-boggling they would allow something like this.
This is the $100 table, as we used to say, so tread lightly and have some trepidation moving forward. But listen, it's still something that's talked about seemingly not necessarily on a daily basis on the network, but we talk about it often in terms of day-to-day coverage. So stay tuned for that. What you also have done relatively well this year is your prognostications in the NFL, the league where they play for pay. We have reached week 14. 22-16 is yeoman's work, I would say. Well done by you. I think embedded into one of these picks is one of your favorite picks of the year. We used to call it a 25-star pick. I don't want to get ahead of myself, but without further ado, Danny Moses, week 14.
All right, I got 3 picks. And let me just say, last week, when I lost the Eagles game, what I did say was, if you wanted San Francisco, go bet Brock Purdy at NFL MVP over 10-1 before that game started. It's a much better way to play San Francisco winning. He's now the leader in the clubhouse, I think, at 2.5-1 or something to be NFL MVP. There's always a hedge out there, even if you don't get the team right, is my point. So 3 games this week. I'll start with Jacksonville and Cleveland. Yes, Trevor Lawrence may not play. Don't care. Give me Jacksonville +3 at Cleveland. What I saw from Flacco looked okay at the beginning, but then showed his true colors, I think, at the end there. So I think Jacksonville actually wins that game outright. Bengals, like, we got backup quarterback central going on around the league, right? And the Colts, the Colts have really beaten nobody. And first of all, they should have lost that game, Tennessee. They just got by Tampa Bay. They beat New England and Carolina. Yeah, they're hot, but they haven't really beaten anyone. And I think the Bengals are fired up after that win. They're a home underdog. Give me the Bengals +1. I think they win that game outright. And then what I think is setting up, and this is kind of against the grain of what I normally do. The Chiefs have lost back-to-back games twice in the last 4 years. I had to go back and look. I think that's what it is. Don't at me if I'm wrong, but I think it's twice, because Reed has a great way of bouncing back. They're at home, laying 1.5 against a bye-rested Bills team, which still really hasn't shown anything they can play on both sides of the ball. I haven't taken the Chiefs really all year. Chiefs 1.5-point favorite at home. I take them, guy.
Love those picks. I like what you did there.
That's 5-star, by the way.
The Bills have been a disappointing team, to say the least, the entire year. By the way, for you Yankee fans out there, before we get out of here, in terms of the Etta James song, at last, my love has come along. My lonely days in the Bronx are over, and life is like a song, as we welcome Juan Soto to the Bronx. Danny Moses, you are the man. I look forward to speaking to you next week.